What's up, everybody? Welcome to episode number 133 here on Season 1. And today we are talking about buying dividends versus buying historical performance. This question comes from a long-time subscriber who asked a few different questions already. Christopher Michael asked, do you feel it's better to invest on stash with ETFs with higher dividends or on historical performance? And the quick answer is yes, both. And I'll just go ahead and try to explain it the best I can. So both are very important when considering purchases, obviously. However, historical performance has nothing to do with the actual financial statements of a company or sector's financial, like a sector's financial. So if you're like tech, it has nothing to do with the tech financials of a company. It just has to do with what value people put on that ETF or those companies that are involved in that ETF. So, for instance, like Amazon, I think is like $800, $900 or something like that. I could be completely off a little bit, but people basically say, "Hey, Amazon, we value Amazon at this price, and so we're going to buy and sell at that price." It'd be like me selling my new shoes. I would say, "Hey, you know what? They're worth $50." And you're like, well, buying from you, I don't know if I can really trust you, blah, 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 blah. I would like to buy them from you for $30. But if I walked into the shoe store at the mall, I would be like, oh, you know what? They value those at $50. I have no problem paying $50 for those. So you put a value on that at $50, but really they're worth $30, what you would pay me, and they're probably actually worth what it costs the company to actually make them. So everything we put value on, however, it has nothing to do with we put a $50 value on the shoes. However, the financials say that they're only worth $10 for them to make. And so the actual material and that kind of stuff is only worth $10. So, for instance, like Defending America has the highest return for me on stash, where I could initially pump it to you guys and be like, hey, buy Defending America. And then along other colleagues or whatever could still also continue to pump it up and be like, buy Defending America. Get on the Stash Facebook group, talk about buying Defending America, and have all these people buying it when I bought in whatever 3-4 months ago and watch it continue to rise up like huge amounts. And then next thing you know, I'm like, okay, it's rose up enough, I'm going to dump my shares. So it's in essence called a pump and dump. And that can happen with those kind of ETFs. Yeah, long term it doesn't happen as much, but definitely you can still see those pump and dumps happen regularly on small penny stocks. It doesn't really happen as much on ETFs, but it could definitely happen as well. So it doesn't really actually give you the appropriate price based upon the financial earnings of the companies that are in that ETF. All it does is give you an idea on what people think it's actually worth. Blah, 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 blah. Whereas dividends are payments that come from the company, usually based upon their performance or profits. They're typically a percent of the stock also, so it could be like 0.25% of the stock price is what you get paid in dividends annually. Well, if it goes up from $100 to $200 the next year, you're going to make twice as much getting paid in dividends. You see what I'm saying? So buying historical price is great, but buying dividends can also just give you a higher rate of return as long as the stock price continues to go up as well. The only issue with investing into dividends is if the company goes out of business, basically, or they decide that we can no longer pay dividends because we don't have a high enough profit, or we're not going to pay dividends anymore. So that's the only thing. That's the only issue with buying dividends, is you're betting against the business going out or them declaring that they're no longer paying dividends, or they're no longer generating profit, like a Sears or Macy's or something like that, JCPenney. So what to choose? Basically, when it comes to buying ETFs on stash, what I'm looking for is a ETF that has a consistent, has a positive rate of return since inception. So I want something that doesn't have a negative growth. I want something that has a positive growth since inception. I don't care about the 5-year, 1 year. I want the entire length, whether that's 10 years, 20 years, or whatever. I want it since inception, positive growth. And then I'm looking for a dividend that beats the expense ratio. So if it's a 3% dividend payment and the expense ratio is 1%, then I think it's a safe buy as far as the stock. So that's what I'm looking at. I'm looking for positive growth and then as well as a dividend payment as well. And then thirdly, I'm also looking for ETF that has historically been paying consistent payments. I don't want something that like, oh, we just started paying dividends this week. Like I don't feel like that's a safe buy. I want something they've been paying dividends for like 3 to 5 years at least. However, my personal view is a little bit different, and this is because the way that I look at it, I'm looking at it like you got to look at who you're betting against. And when you're buying historical price, you're betting against a fellow stock trader or a company that's investing. So you're either betting against like a huge investment firm, or you're betting against another small term investor like yourself. So whereas would be buying historical data, buying a ETF based upon the dividend price, you're betting against the company not going out of business. You're betting against them determining not to pay any dividends anymore, or you're betting against them not generating profits. So I think that for me, it would make it safer. It would be a safer bet for me to bet on the company than try to bet against like a high-end investment for like a Merrill Lynch or a JP Chase Morgan or something like that. I think that it would be safer for me to bet on Coca-Cola than try to bet against JP Chase Morgan. You know what I'm saying? So that's how my personal experience is. However, if you're going to bet on dividends, you're not going to get as high as return if you were to bet against historical price, just because the nature of the beast. People are willing to bet more money on a historical price than they are on dividends, and so on and so forth. So anyways, that wraps it up. Let's go ahead and dive into the question of the day, and that is, do you trust the police? And, for the most part, I do actually still trust the police quite a bit. There's a few things that I disagree with, and lack of distrust. I don't agree with the fact that they feel like they can speed without being coded, without their lights on. I don't think that that's right. I think that there should be a way for the citizens to keep the police accountable. Right now, I don't feel like there's a good accountability system in place, and I think that that's why most people are frustrated, is that the general population cannot keep the police accountable. And so we're relying on other government entities to keep the police accountable. And so it's like if they're in cahoots, then the general population gets screwed. And that's how I feel about that. Anyways, if you guys have any questions regarding Stash, Acorns, or Robinhood, as well as general investing advice, business, Etsy, or coaching, always post those questions down below, and I will try my best to get them on the next episode. But until next time, don't forget to subscribe right up here in this corner, and check out my trading or my investment strategy for Stash Retire, and then check out this other video right here. And as always, thank you for watching. I really appreciate it.